I'm Roger Montgomery and welcome to this week's Video Insight. The forecasts for the stock market this year are bookended by those who believe a deteriorating global and US economic picture will stop the S&P 500's rally in its tracks, with the market retesting and perhaps exceeding its recent lows, and those who believe the worst of Trump-inspired uncertainty is behind us, a much more palatable version of tariffs will ultimately prevail, and the market will roar to new highs. Over the last few years, we've urged investors to consider the combination of inflation and growth to help determine whether equities would experience buying support. Historically, well, since at least the 50s, the best returns for equity markets have occurred during or after a period Gavical research called a disinflationary boom, when disinflation coincides with positive economic growth. With Trump likely to settle on some combination of tariffs that are lower than the Liberation Day version, the question to ask is whether US inflation rates will decline further or whether inflation will rise, even as tariffs settle at 10% generally and 30% on imports from less friendly trading nations. Regarding economic growth, the consensus amongst economists is rapidly shifting from recession to slowing growth but not negative growth. It's worth noting that imports are subtracted in the calculation of GDP in the US. This is because GDP measures the total value of goods and services produced within a country's borders, and imports, of course, represent production that occurred outside of the country. So the very high volume of imports that occurred in the first quarter as importers front-ran Trump's tariffs reduced GDP, resulting in the US's first quarter of negative economic growth. And that's unlikely to be repeated. With respect to inflation, my guess is that we may see inflation persist around current levels or even slightly higher. And if that's wrong and inflation keeps declining, well, that's good news. But even if it is slightly higher, I believe investors will look past the current turmoil with something of an optimistic bias. Trump appears to be easing into a disposition towards change and upheaval that is more market-friendly. That said, there are always risks, and Warren Buffett's staggering pile of cash, along with the comment that he'll be hanging around where needed after his retirement in case of, quote, special opportunities, end quote. It does suggest that it may be sensible to also hold some cash on the sidelines. Turning to market valuations, with the exception of COVID and the recent market highs, the PE ratio for the S&P 500 is higher than at any other time in the last 23 years. Of course, that doesn't mean anything. PE ratios can stay high forever. By themselves, high PE ratios don't predict a crash or even a correction, but they do make investors more sensitive to any bad news. For what it's worth, I said at the beginning of the year that 2025 would deliver heightened volatility thanks to Trump, and that the S&P 500 returns should be mildly positive. I suggested single-digit positive returns, and that was partly based on historical precedents. I don't think we've ever seen 3 consecutive years of high double-digit returns, well, not since after the Great Depression. As long as growth remains positive, or that investors can see that it will remain positive, and inflation doesn't surge, or if it does, it isn't expected to persist, then the outlook for the rest of the year remains modestly supportive. The risk is Trump himself. I remain convinced that he goes to bed not knowing what he's going to talk about tomorrow, although it's reasonable to assume he will say and do things that benefit him and his family. Perhaps that's the best investing strategy after all. When the US cuts a deal with China on tariffs over a weekend, should we be surprised that the details aren't announced until a market trading day? Well, that's all we've got time for today. See you next week, and in the meantime, continue to follow us on Facebook and X.